Something is happening right now that the mainstream financial media is completely ignoring. And if you own retirement savings in any form, you need to hear this before the week is over. I'm going to walk you through exactly what's unfolding in the silver market at this very moment. We're talking about a chain of events that market veterans are calling a once in a generation supply crisis. And the data coming out of the exchanges right now is frankly alarming. But first, let me ask you something. Do you remember the last time you stood in a grocery store and reached for something on the shelf and it simply wasn't there? Not because you were too late, not because someone else grabbed the last one, but because the supply chain had completely broken down behind the scenes and nobody told you until you were staring at an empty shelf. That feeling, that sudden stomach dropping moment when you realize what you thought was always available actually isn't, that is precisely what is beginning to happen in the silver market right now. Except the consequences aren't an empty shelf. The consequences are measured in retirement accounts, in purchasing power, in the financial security of millions of ordinary Americans who had no idea this was coming. So let's pull back the curtain. Let's look at what the numbers are actually saying, because this is not speculation. This is not doom and gloom commentary from someone trying to scare you. This is data. Cold, hard, verifiable data from the exchanges themselves. Right now, the spot price of silver sits around $71 per ounce. And at first glance, you might think, okay, that's elevated, that's high, but it's still accessible. People are still buying it, dealers still have some inventory. So what's the crisis? Why does this video carry the word breaking in the title? Here's why. The crisis isn't about the price. The crisis is about what's happening beneath the price. In the vaults, in the warehouses, in the exchange mechanics that almost nobody outside of Wall Street and the trading floors actually understands. And once you see it, you cannot unsee it. At the COMEX, which is the primary exchange in the United States where futures contracts for silver are traded, there are two categories of silver that matter. The first is called eligible silver. This is silver sitting in approved vaults that meets quality standards. It's technically there. It's physically present. But here's the critical distinction. It is not available for delivery. It belongs to private owners who have chosen to store it at the exchange but have not made it available for anyone to claim. Think of it like money in a savings account that you can see on the screen but have frozen from withdrawal. The second category is called registered silver. This is the silver that actually counts. This is the metal that can be physically delivered when a futures contract comes due. This is the stuff that backs the paper. And right now, the registered silver sitting in COMEX vaults, the silver that can actually be delivered to someone who demands it, stands at approximately 85 million ounces. 85 million ounces. Write that number down. Now, here's where it gets terrifying. The open interest on COMEX silver contracts, meaning the total number of paper claims on silver that currently exist in the futures market, stands at over 535 million ounces. 535 million ounces of paper claims against 85 million ounces of registered, deliverable physical metal. That is a leverage ratio of over 6 to 1. For every single ounce of silver that actually exists and can be delivered, there are more than 6 paper contracts claiming ownership of that same ounce. In a calm, orderly market, this works fine. Most people don't demand delivery. They roll their contracts, settle in cash, and move on. The system is built on the assumption that only a tiny fraction of contract holders will ever actually show up and say, "Give me the metal." But what happens when that assumption breaks down? What happens when more and more holders of those contracts show up and say, "I want the physical"? The delivery coverage ratio right now is sitting at 15.9%. That means that if even 1 in 6 holders of open contracts decided to demand physical delivery of their silver simultaneously, the entire registered inventory at COMEX would be gone. Completely wiped out. And the exchange would face a default scenario that would send shockwaves through every financial market on the planet. Now, before I keep going, if you're watching this and you're sitting on $100,000 or more in retirement accounts, whether that's a 401k, an IRA, a pension rollover, I put together a free guide in the description below that breaks down exactly how thousands of American retirees are protecting their hard-earned wealth through saving strategies that most financial advisors never talk about. It's completely free. Just check the description and grab it while you're watching. Now, back to what's happening. The situation at the COMEX is just one piece of this puzzle, because what's driving the demand for physical delivery isn't just retail investors or YouTube viewers waking up to the story. The real force behind this supply crunch is industrial demand, and it is running at levels that would have seemed impossible just a decade ago. Silver is no longer simply a monetary metal. It is an industrial metal that happens to also function as money. And the industrial applications consuming silver right now are not shrinking. They are exploding. Solar panels require silver. Each panel uses a small but significant amount of pure silver paste for the photovoltaic cells. And as the global build-out of solar capacity continues to accelerate, driven by energy security concerns, climate policy, and sheer economics, the amount of silver being consumed by the solar industry alone is staggering. We're talking about hundreds of millions of ounces per year flowing into solar panels that will never be recycled. That silver is gone, locked into panels that will sit on rooftops and solar farms for decades. Electric vehicles require silver. Every EV contains multiple ounces of silver in its electrical systems, battery management circuits, and charging infrastructure. And that's before you even factor in the charging networks being built out around the world. Every single charging station requires silver in its components. Every grid upgrade, every smart meter, every power management system being installed as the world electrifies, all of it consumes silver. Artificial intelligence requires silver. This one catches people off guard, but the data centers powering the AI revolution require massive amounts of electrical infrastructure, and silver is embedded throughout, in the conductors, the connectors, the circuit boards of the servers themselves. The build-out of AI computing capacity over the next several years represents a demand driver for silver that most analysts haven't even begun to properly price in. And here's what makes this particularly acute right now. Global silver mine production grew by less than 1% last year, reaching approximately 820 million ounces. 820 million ounces of new supply from mines worldwide. Meanwhile, total global demand crossed 1.16 billion ounces. Do that math. Supply, 820 million. Demand, over $1.1 billion. That's a structural deficit of over 300 million ounces in a single year. And this isn't a one-year anomaly. We have been running these deficits consecutively, year after year, since at least 2021. The cumulative shortfall has now grown to roughly 820 million ounces of unmet demand stacked up over those years. The market has been quietly consuming above-ground stockpiles to make up the difference. And those stockpiles are not infinite. Now, let me tell you a story that may sound eerily familiar to what we're watching today. The year is 1979. Two brothers from Texas, Nelson Bunker Hunt and William Herbert Hunt, have been quietly accumulating silver for years. Their thesis was simple. The dollar was being debased through inflation. Government spending was out of control, and hard assets were the only real protection. Sound familiar? They started buying silver in the early 1970s, and by 1979, they had accumulated somewhere between 100 and 200 million ounces, roughly a third of the world's above-ground supply at the time. What happened next became one of the most dramatic commodity squeezes in history. As the Hunt brothers and their Arab partners began demanding physical delivery rather than cash settlement, the price of silver went parabolic. It went from roughly $6 an ounce in early 1979 to almost $50 an ounce by January 1980. That's an 800% move in under a year. People lined up around the block at coin shops. Dealers ran out of inventory. Refineries were melting down silverware and jewelry to feed the demand. The complacency that had existed for years, the assumption that silver was always there, always available, always accessible, shattered overnight. And the critical thing to understand about that moment is this. It didn't happen because of some external shock. It didn't happen because of a war or a natural disaster or a sudden technological revolution. It happened simply because a group of large players decided they wanted the physical metal instead of the paper. The existing supply structure, built on decades of assumptions about how people would behave, simply couldn't handle the change in behavior. Now fast forward to 2011. Silver ran from around $18 per ounce to nearly $50 per ounce in the space of a few months. Once again, a combination of physical demand, paper claims, geopolitical uncertainty following the financial crisis, and concerns about currency debasement created the conditions for a violent price spike. Once again, dealers found themselves scrambling to source product. Premiums over spot skyrocketed. Delivery times stretched to weeks or months, And then, as has happened in every silver spike throughout history, the exchange itself stepped in and changed the rules. COMEX raised margin requirements for silver futures multiple times in a single week, 5 separate margin hikes in 9 days, specifically to cool off the buying frenzy and protect the short sellers who were caught wrong-footed. The price crashed. The squeeze was broken, not by market forces, by regulatory intervention designed to protect the very system that had enabled the imbalance in the first place. Here's the question you should be sitting with right now. What happens when the system doesn't have enough physical metal to intervene? What happens when the deficit is so large, the structural mismatch so deep, that no amount of margin hike can conjure silver into existence that simply isn't there? Because we are not in 1980. We are not in 2011. The demand backdrop today is fundamentally different from anything that existed in either of those prior periods. In 1980, silver's industrial applications were relatively limited. The solar industry didn't exist. EVs were science fiction. AI was a concept in academic papers. The demand that crushed supply in 1979 and 1980 was primarily investment and speculative demand. Today's demand is structural and industrial. It is baked into the architecture of the modern economy. You cannot build solar panels without silver. You cannot build EVs without silver. You cannot build the AI infrastructure of the next decade without silver. These demands do not go away because someone raises a margin requirement. And on top of all of this sits another dynamic that most people in the West are completely unaware of. China has been reclassifying silver as a strategic resource. What this means in practical terms is that silver that used to flow freely in global trade is increasingly being retained within China. Chinese exports of silver have been restricted. The silver that industrial users in Europe and North America previously sourced from Chinese suppliers is no longer reliably available. This is forcing buyers to turn to the Western exchanges, to COMEX, to the LBMA in London, to source the physical metal they need. And that incremental demand is landing on a market that was already running on fumes. Let me paint you a picture of what the data actually looks like right now. You have 85 million ounces of registered silver at COMEX. You have over 500 million ounces of paper claims against it. You have industrial users who need the physical metal and cannot substitute anything else. You have China pulling silver eastward and limiting its outflow. You have solar demand, EV demand, and AI infrastructure demand growing in parallel. You have mine production that is functionally flat. And you have a cumulative deficit of over 800 million ounces since 2021 that has been silently draining the world's accessible stockpiles. Every single one of these forces is pointing in the same direction. The paper claims look increasingly disconnected from physical reality. The gap between what the exchange says exists and what people can actually demand and receive is widening. And the trigger that converts this slow-motion crisis into a fast-moving one is not far-fetched or speculative. It is a simple change in behavior. It is enough large holders of futures contracts deciding at the same time that they want the metal, not a cash settlement, not a roll, but the actual silver in their hands. When that happens, and the data suggests the pressure for it to happen is building with every passing week, the price discovery mechanism for silver will not work the way it has worked for the last several decades. The price will not be set by someone making a measured calculation about macroeconomic conditions and then placing an order. The price will be set by whoever has physical silver and whoever needs it desperately, and the distance between those two numbers in a genuine squeeze event is something that most people sitting comfortably in paper assets today simply cannot imagine. There's one more dimension to this that I want to make sure you understand before I wrap up, because it connects directly to the situation that many of you watching this are in right now. We are living through a period of extraordinary financial uncertainty. Geopolitical tensions are fracturing the global trading order. The dollar's reserve currency status is being challenged from multiple directions, by BRICS nations pursuing alternative payment systems, by the movement of gold reserves away from Western custodians and back to sovereign vaults, by the quiet but accelerating trend of nations settling bilateral trade in currencies other than dollars. Tariff regimes are reshuffling global supply chains in ways that economists are still struggling to model. Equity markets have shown in recent years just how violently they can move when sentiment shifts and liquidity dries up. And yet, trillions of dollars of retirement savings sit in exactly the kinds of assets that are most vulnerable to these dynamics. stocks, bonds, and cash. While one of the hardest, most historically resilient stores of value in human history is sitting at levels that look cheap relative to every structural driver pointing at it. If you have a meaningful amount of retirement savings and you're not thinking about how physical precious metals fit into your allocation, I want to take 30 seconds and mention something directly. A gold IRA or a silver IRA allows you to hold actual physical metal inside a tax-advantaged retirement account, not an ETF that tracks the price, not a mining stock. Actual bars or coins in a secure vault inside the legal framework of your retirement account, with all the same tax protections you already benefit from. For people sitting on significant retirement assets who are watching everything I've just described and feeling the weight of it, the supply squeeze, the structural deficits, the geopolitical realignment, the vulnerability of paper assets in a world that is clearly changing, this is something worth understanding before the window to act in a measured, unhurried way closes. The link in the description has a free guide that covers exactly how this works. Now, coming back to where we started, the supply being gone by Friday night. That headline is not hyperbole for its own sake. It reflects a precise technical reality. The deliverable silver at COMEX represents a tiny fraction of the contracts outstanding against it. The rate at which registered silver has been leaving vaults has been accelerating. The delivery pressure relative to available supply is sitting at nearly 300% of what can actually be delivered. In a futures delivery cycle, the window between when contracts become deliverable and when they expire is short. We are in that window. And the math of what's available versus what's being demanded is genuinely alarming in a way that doesn't require any extrapolation or worst-case assumption. The numbers speak for themselves. And here is what I want you to take away from all of this. Beyond the urgent headline, beyond the COMEX mechanics and the industrial demand numbers and the historical parallels, what I want you to understand is that the time to prepare for a supply crisis is not when the crisis is visible to everyone. It is now, when the data is clear to those who look, but the mainstream has not yet caught up. The people who were protected during the Hunt Brothers squeeze were the people who already had physical silver before the chaos began. The people who were protected during the 2011 run were the people who had accumulated positions before premiums spiked and delivery windows stretched. The pattern is always the same. Those who understand the mechanics act before the crowd, and the crowd discovers the situation only after the easy entry points are long gone. The supply picture for silver is not a problem that can be resolved quickly. You cannot mine your way out of a structural deficit in months or even years. New silver mines take anywhere from 7 to 15 years from discovery to production. The industrial demand driving this deficit is not going away. It is embedded in technologies that are being scaled at the fastest pace in human history. The paper claim sitting on top of a dwindling physical pool cannot be resolved by simply printing more paper. They can only be resolved by reality asserting itself. And when reality asserts itself in commodity markets, it tends to do so with extreme speed and extreme violence. For those of you who have watched this entire video and are sitting on $100,000 or more in a retirement account, I want to leave you with one final thought. The guide in the description below is free. It covers the savings strategies thousands of American retirees are using right now to protect their wealth. And if you reach out to mention that you watched to the end of this video, you're eligible for a complimentary one-on-one educational web conference, completely private, no sales pressure, no obligation, where you can walk through your specific situation with someone who can answer your exact questions. That offer is only available to American retirees with at least $100,000 in qualifying retirement assets, and it exists because the conversation that needs to happen right now is too important and too personal to have in a YouTube comment section. The silver supply clock is ticking, the math is unforgiving, and the window to act on what you now know is open right now. But as everything else about this story demonstrates, windows like this do not stay open indefinitely.